Hey everybody, this is David Skrika, Profit from Pessimism, stock chart of the day, whatever you want to call it. So today we're going to look at we're going to get back to the Buffett indicator. I think this is interesting because of the market's recent rally. We've seen this indicator actually go to an all-time high. So for those of you who don't know, the Buffett indicator is basically just takes the market cap of the stock market and divides it by the GDP of the country. And this is the Wilshire 5000 to GDP. This is the value of all public and private equities to GDP. And this is the Dow to GDP ratio, and this is the S&P to GDP. This is the one I really like to use, the S&P to GDP, and etc. But the Wilshire, which is all stocks, we can see has gone to a new all-time high. It went to nearly 210% in 208.62 at the high earlier this year. This is like on a monthly close, so I think actually on the daily high earlier this year was around 206, 207, and you can see it hit nearly 200% back in 2021, which was the highest ever. And actually, this was considered a nosebleed level back in 2000. Now, what's interesting when it hit about 150%, and then it hit again over 100. Now, before 2000, it had never been over 100% of GDP. In 2007, it hit again, and then the market sold off. And one reason that I was like wrongly about this time, about this, in like 2014, 2015, I became bearish on the markets because again, we hit over 100%. And I thought that was going to be it. And then, of course, the last 10 years have kind of been an anomaly. It's probably the combination, a lot of those 10 years having zero interest rates, all this trillions of dollars of printed money, and the financialization of the economy where everyone's in the asset markets, etc. So, and you can see this can happen for for a while because you can see the mean historically is about 80%. And that's moved up because of the last 10 years. It was like 2/3 before that. And you can see, we spent nearly 10 years from the mid 70s to the mid 80s below 50% of GDP. So these things can happen. So I think you kind of move where we were in the mid 70s to mid 80s upside down, which was the start of this great bull move. And you kind of look where we were the last 10 years since about 2014, 2015 to 2025. And it's kind of like the opposite. So what happened in those 10 years after, those 40 years or roughly after 1984 is that we had higher equity markets basically for 40 years. So are we going to now see a long-term period where equity markets kind of lag? And especially if interest rates continue to move higher, they're in a secular bull market. I mean, the rates themselves, the bonds, in a secular bear market. We have debt problems. So maybe the setting is there for finally asset markets to begin to really, really underperform. You can see on this correction, we only got to 141%, which is about where we were at the high in 2000. Just shows you. And of course, that one reason is all the Magnificent Seven, these mega caps. That's a big reason for this. So we can also see it too in the S&P ratio to GDP. You can see the S&P itself, again, and has it a new high, beat the high of last year in 2021. And it should be noted that 2021 high was followed by about a 25% correction in the S&P and a 30% correction in the NASDAQ. So that's basically it. So anyhow, that's basically it. So that's basically it. So that's all I wanted to show you. Okay. Anyhow, you can just see we're at these all-time highs, and what does this mean? And you can see you can spend a number of months here, like here, and really when we hit this high here, and this was like September 2021. It stayed that level till January 2022. So that's 3-4 months, right? Same here in 1999, we started hitting this extreme level in about the summer of 1999, and of course it continued there until about, you can see, about September 2000. So it really took like a year for that to top out. Will it this time? I don't know. But I would definitely think like, 3-4 months, et cetera, maybe like from now to the end of the summer, we don't really see an acceleration and maybe selling until the fall. But we can see that this is an indicator, and this is a long-term indicator. And look, this is a long-term also in terms of if you would have bought here, again, at that 2000 highs, equity markets themselves did terrible for the next 9 years. Like, the S&P was down over 50%, obviously much more inflation adjusted in 2009 over the next 9 years. And then if you would have bought in 2009, look what we've done in the next 15 years. Same thing. If you want to buy anywhere from the, 1974 bottom in stocks to that 1984, 85, 86 period, you would have done fantastically over the next 10, 15 years. So it really is a longer term indicator. And I know it hasn't worked great in the last, 10 years. Like you could have bought here when it was over 100%. And you still did fine. The S&P has gone from like 2000 at that time to like 6,000, but that's kind of anomaly, I think. And I think right now these extremes, we can see what happened at the end of 2021 into 2022. So I just wanted to show you that, and we're at this extreme valuation, and I just think the upside is very, very limited. And this is why I've kept tight stop losses on these turnaround plays that I have. And I don't mind just being boring. And other than some of my gold and silver plays, I don't mind being in a lot of cash because I know at some point we are going to get a buying opportunity. Now, will the buying opportunity end up being just another smash like happened this spring? Will be a shallow bear market like 2021 or 22? Will it be a longer term, deeper bear market like 2000 or 2008? I don't know. I don't have a crystal ball, but I just wanted to show you that the Buffett indicator again is showing us signs of extreme valuations.